Hello, I'm Bernard Hickey with the Daily Briefing from interest.co.nz. Today we'll look at some concerns the Reserve Bank has about the way banks are funding their lending. And we'll check out what the ultimate CEO of our largest banking group, that's ANZ National, thinks about the global credit crunch. But firstly, we look a bit more closely at what Reserve Bank Governor Alan Bollard said in Paris on Friday night about how banks fund their lending. Essentially, he gave them a little bit of a warning that they're borrowing short and lending long, which meant they're a little bit vulnerable if suddenly global investors stop lending to New Zealand. Borrowing short and lending long is generally a bad idea. It means that if suddenly depositors want their money back in a hurry, then banks would have to liquidate their loans. Generally, banks and finance companies try to match the maturities of their lending and borrowing. But currently the banks are taking in a lot of short-term deposits from investors worried about finance companies and other investments. They're generally for 6 to 12-month terms. They're also borrowing at shorter terms on wholesale money markets because of the turmoil there. Then on the other side of their books, the banks lend to home buyers for 20 to 25-year terms. The banks rely on the fact that many people pay back their mortgages early when they sell a house or move to another mortgage provider. These mortgages actually have a real term which is closer to 18 months to 2 years, so there's still a gap there. The banks borrow at 6 to 12 months and then lend out at 18 months to 2 years. The Reserve Bank isn't warning about any failures, but it's just sending out a gentle caution. Now for a quick look at what the new CEO of the ANZ Banking Group in Australia, Mike Smith, is saying about the credit crunch and the likely fallout in this part of the world. What he says is important because he controls the bank, which collectively has over a third of all New Zealand bank deposits and lending. He's not pulling any punches. He said in an interview with the Business Spectator website that he sees global losses from the subprime credit crunch approaching $1 trillion and that it won't calm down until June next year. He says Australia's banks, which also means New Zealand's banks, have relatively little exposure to this crisis, and he doesn't see any big bank failures either in Australasia or the rest of the world. But he does see the cost of wholesale funding rising, which will have to be passed on to customers. He also hinted that banks may have to raise extra capital to cope with all the corporate lending that will come back to the banks from the wholesale markets. ANZ National is already doing this in New Zealand through its perpetual note issue on the NZDX to raise up to $400 million in Tier 2 capital. I'm Bernard Hickey from interest.co.nz with the Daily Briefing. Catch you on Tuesday.